Welcome back to FOREX School. In our last lesson, you learned how to find genuine support and resistance, the levels where price has a memory. And I left you with a promise that those levels don't just sit there in flat markets. They move, they climb, they stack on top of each other. Today, we keep that promise. This is Lesson 2, Trend Structure, How Levels Behave in Trending Markets. By the end of this lesson, you'll be able to look at any chart and answer 3 questions with confidence. Is this market trending? Which way? And most importantly, is that trend still healthy? Grab a coffee, open your charts, and let's get into it. First things first. Before we can talk about how levels behave inside a trend, we need to agree on what a trend actually is, and it's probably more precise than you think. Most new traders think a trend is just a price going up or price going down. But professionals define it structurally. An uptrend is a sequence of higher highs and higher lows. Each swing peak exceeds the last, and each dip bottoms out above the previous dip. A downtrend is the mirror, lower highs and lower lows. That's it. No indicators required. The beauty of this definition is that it's objective. You can point at the exact swings on the chart. And each of those swing points is a level, exactly like the ones from Lesson 1. Watch this. Price pushes up strongly, then eases back, but notice where it stops falling. Right here, above the previous dip. That's a higher low, buyers stepped in early. Then price rallies again and pushes beyond the last peak, the higher high. And the pattern repeats, pullback, higher low, rally, higher high. See how each higher low sits above the one before it? This is the staircase. As long as every low is higher than the last, and every high clears the previous one, this uptrend is structurally intact. The most recent higher low, this level here, is now the line the bulls must defend. Now look closer at the rhythm of that staircase. Trends breathe in 2 phases. The impulse is the strong leg in the trend direction, big candles, conviction, momentum. The pullback is the pause, smaller candles, overlapping, drifting against the trend as some traders take profit. Here's the key insight: pullbacks are not the trend failing. They're the trend refueling. The impulse tells you who's in control, the pullback tells you where the next opportunity might form. Experienced traders wait for the pullback to finish rather than chasing the impulse. Here's the same logic in a downtrend, so you can train your eye both ways. Watch this. Price is moving down, a heavy impulse leg, sellers in full control. Then it lifts, drifting back up, and at this level, the rally stalls below the previous peak. That's a lower high. Sellers step back in, and price drives to a fresh lower low. Again, weak pullback up, lower high, impulsive leg down, lower low. Notice the character difference: the down moves are fast and decisive, the recoveries are slow and reluctant. That imbalance is the trend's fingerprint. Lower highs and lower lows, stepping down the chart. So how does everything from Lesson 1 fit into this? Beautifully, as it happens. Role reversal, the flip from resistance to support, is the very engine that drives a trend forwards. Remember role reversal? When price breaks through resistance, that old ceiling often becomes the new floor. In a trending market, this happens over and over, in sequence. Each broken resistance becomes the support that catches the next pullback, and very often, that retest is where the next higher low forms. So the trend isn't magic, it's a chain of role reversals, each one confirming that buyers now own a level sellers used to defend. When you see a pullback approaching a freshly broken level, you're watching the market decide whether the trend continues. Let's watch it happen. Price climbs into this level and gets rejected, resistance, tested once, then tested again. Sellers are defending it. But look at the higher low forming beneath, pressure is building. Then, there it is. A decisive breakout candle closes clean through the level. Now the crucial part. Price doesn't just run away, it pulls back, drifting down towards that old ceiling, and right here, at the retest, buyers step in. The old resistance holds as support. From that flip, price launches to a new higher high. One level, two rolls, and the trend rolls on. One more idea before we get to the big one. Not every level in a trend is horizontal. Because trending swings step diagonally, the levels effectively climb with the market, a rising line of higher lows in an uptrend, a falling line of lower highs in a downtrend. Traders call these dynamic levels, and you'll often see them drawn as trend lines or tracked with moving averages. Treat them exactly like horizontal levels, zones, not laser lines, and only meaningful with multiple clean touches. The concept is identical, a region where one side of the market repeatedly steps in. Right, here's the moment this whole lesson has been building towards. If a trend is defined by structure, then there is one precise event that tells you the trend is in trouble. An uptrend lives as long as its pattern holds, higher highs, higher lows. So the trend change tell comes in two warnings. Warning 1, price fails to make a new higher high, the rally stalls short and prints a lower high instead. Buyers are losing their nerve. Warning 2, the confirmation, price breaks below the most recent higher low. That's the structure break. The staircase has cracked. It doesn't guarantee a full reversal, sometimes markets just go sideways, but it does mean the uptrend, as defined, is over. Same logic in reverse ends a downtrend. Watch this closely, it's the most important chart of the lesson. The uptrend looks healthy, higher low, higher high, another higher low, another higher high. Textbook. Then price pulls back to this higher low and bounces, but here's the first crack. The rally runs out of steam below the previous peak. That's a lower high, warning 1. Now all eyes on the level beneath, the last higher low. Sellers press down, down, and there it is. A full candle closes below the level. Structure break, warning 2, confirmed. The staircase is broken, and notice how the old support is already being treated as resistance. So how do traders actually use all this? The principle is simple, trade with structure, not against it. In an intact uptrend, the higher probability behavior is looking for buying opportunities at pullbacks into support, those role reversal retests we watched earlier. The lower probability behavior is selling into strength, hoping to catch the top. Structure also gives you a natural line in the sand. If the level that made your idea valid breaks, the idea is wrong. The trend is your context. Levels are your locations. Structure tells you when the story changes. Before we wrap up, let's save you some pain. There are two mistakes that almost every new trader makes with trends, and both of them are completely avoidable once you can read structure. Mistake 1, counter trend fading. The market has printed 5 higher highs and it looks too high, so the beginner sells, fighting a structure that's still perfectly intact. Remember, a trend is innocent until proven guilty, and the proof is a structure break, not a feeling. Mistake 2 is the opposite sin, chasing extended moves. Buying at the very top of a stretched impulse, miles from any support, just as the pullback is due. Both errors come from ignoring structure. The fix is the same for both. Locate the swings, respect the levels, and let the pattern, not your emotions, tell you what's happening. Let's lock in what you've learned today. A trend is a structure, higher highs and higher lows going up, lower highs and lower lows going down. Trends breathe in impulses and pullbacks, and the pullback is where opportunity lives. Broken resistance flips to support and catches those pullbacks. Role reversal is the engine of every trend. Levels can climb diagonally too, as dynamic support and resistance. And the trend change tell is a two-step signal, first a lower high, then a break of the last higher low. Trade with structure at the levels, and never fight a staircase that's still climbing. And that's lesson 2 complete. You can now read the skeleton of any trend on any chart. Your homework: open 3 currency pairs, mark the swings, and label each market as uptrend, downtrend, or broken structure. If you're finding this course valuable, subscribe and turn on notifications so you don't miss what's coming, because in Lesson 3, we take structure to the next level and tackle multiple timeframes, how a pullback on the daily chart is a full trend on the 1 hour, and how to line them up. One last reminder before you go, everything in Forex School is education, not financial advice. No strategy guarantees profits, and trading carries real risk. Never trade money you can't afford to lose. Thanks for studying with me, and I'll see you in Lesson 3.